In early January, while much of the global economy was still operating at half speed, something unusual took place beneath the surface of the financial system. There were no emergency press conferences, no public warnings, no breaking news banners. Yet inside the vault network that underpins the global silver market, a movement occurred that demanded attention from anyone who understands how modern finance truly works. Deutsche Bank did not announce a strategic shift. It did not release a statement about reallocating assets. Instead, it quietly transferred nearly 3 million ounces of physical silver out of its control. On the other side of that transfer stood J.P. Morgan, absorbing the metal without hesitation. To an uninformed observer, this might have appeared as a routine transaction between two large institutions. To those familiar with physical commodity flows, it was anything but routine. This was not a paper trade settled through accounting entries. It was not a futures position rolled over or offset. It involved physical silver, bars stored in regulated vaults, subject to strict inventory classifications. Physical silver moves slowly in normal conditions. When it moves quickly and in size, it usually means one thing: confidence somewhere has weakened. The silver in question was tied to the delivery system of the futures market, administered by the CME Group through its metals exchange. That system relies on a delicate balance. Contracts are traded in massive volumes, but only a small portion ever results in physical delivery. This works as long as most participants are willing to settle in cash. The moment that changes, stress appears. In this case, delivery notices surged. Contracts that could have been closed on paper instead stood for physical settlement. Each contract represented 5,000 ounces of silver. Over a short period, thousands of these contracts demanded delivery. The result was one of the largest two-day physical silver movements in recent history. What made the situation more serious was not just the volume moved, but the source. Deutsche Bank was not a marginal player liquidating excess inventory. It was one of the largest global banks, operating with access to capital, information, and liquidity that smaller institutions could not match. When such an institution releases physical metal into the delivery system, analysts pay attention, not because of what is said, but because of what is done. J.P. Morgan's role was equally revealing. It did not hesitate. It did not delay. It accepted the metal as it became available, increasing its physical holdings at a time when many banks prefer to reduce exposure to commodities. This behavior suggested preparation rather than speculation. Large banks do not accumulate physical assets unless they believe those assets will matter in ways paper claims cannot replicate. The registered inventory of silver, the category of metal available for immediate delivery, had already been declining before this event. Registered silver is the backbone of the exchange. It is what allows futures contracts to maintain credibility. When registered inventory falls too low, the system begins to rely on confidence rather than metal. At the time of the transfer, registered silver levels were approaching thresholds that historically trigger concern. What occurred then was not merely a transfer between two banks. It was a visible extraction of confidence from the system. Each ounce that left registered inventory reduced the margin for error. Each delivery notice that stood instead of settling quietly increased pressure on the exchange to perform. Importantly, none of this happened during market panic. Prices were not exploding upward. Volatility remained contained. This calm exterior made the movement more unsettling. It suggested that the actors involved were not reacting emotionally. They were acting deliberately, early, and with purpose. For the business community and for young entrepreneurs watching global markets, the lesson was subtle but critical. The most important signals in finance rarely come from headlines or prices. They come from behavior. When institutions with the most to lose choose physical control over contractual promises, they are revealing how they assess future risk. This transfer marked the beginning of a story that extended far beyond silver itself. It raised questions about trust, settlement, and the real meaning of liquidity in a system built on leverage, and it hinted that some players were already positioning for conditions that had not yet become visible to the broader market. What followed would deepen those questions and challenge assumptions about how stable the system truly was. What made the situation more serious was not the size of the silver movement alone. It was the condition of the system receiving that demand. The global silver market operates on a structure that appears stable from the outside, but internally it depends on classifications, assumptions, and timing. At the center of that structure sits the futures exchange system, where promises and metal are expected to align, most of the time. Within the system, silver is divided into two categories. The first is eligible inventory. This metal exists inside approved vaults. It meets all quality standards, but it is not promised to anyone. Its owners are under no obligation to deliver it. It is silver in storage, not silver in circulation. It offers comfort to observers, but it does not guarantee functionality. The second category is registered inventory. This is the critical layer. Registered silver has legal warrants attached. It is available for delivery to any contract holder who demands physical settlement. This metal is not symbolic. It is operational. Without enough registered inventory, the exchange cannot fulfill its core purpose. The exchange overseeing this process is the COMEX. For decades, COMEX has functioned smoothly because most participants did not want metal. They wanted exposure. They wanted price movement. Cash settlement became the norm, and physical delivery became the exception. That balance allowed large volumes of contracts to exist on top of relatively small physical reserves. But balance is fragile. It holds only as long as behavior remains predictable. As delivery notices surged, registered inventory began to fall at a pace that raised concern among analysts who track vault data closely. Every contract that stood for delivery forced the system to convert registered silver into outbound metal. When registered inventory drops too low, the exchange must rely on one of two things: owners of eligible silver volunteering to convert their holdings, or confidence that future contracts will settle in cash. Neither option is guaranteed. What troubled observers was that eligible silver was not converting fast enough to offset the drawdown. This suggested hesitation. Owners were choosing to keep their metal out of circulation rather than make it available for delivery. In normal conditions, higher prices or incentives encourage conversion. In stressed conditions, owners prefer control over yield. This behavior changes the meaning of inventory numbers. Total silver in vaults may appear large, but if most of it is locked away by owners unwilling to deliver, the effective supply is far smaller than reported. In such moments, inventory becomes an illusion of safety rather than a source of stability. The timing added another layer of concern. The surge in deliveries occurred at the very start of the year when institutional participation is typically low. Many desks were lightly staffed. Liquidity was thinner than usual. Moves made during these windows tend to be intentional. They are chosen precisely because fewer eyes are watching. At the same time, broader signals were beginning to shift. Industrial demand for silver was already under pressure from energy transitions and manufacturing expansion. Geopolitical trade frictions were increasing uncertainty around supply chains. In particular, new restrictions affecting exports from Asia reduced expectations of flexible swing supply entering Western markets. This meant the system had fewer buffers than before: less spare metal, less willingness to lend, less tolerance for delays. In such an environment, the decision by institutions to demand physical settlement carries weight. It forces the system to prove that it can do what it promises, and every successful delivery reduces the margin for the next one. For business leaders and entrepreneurs, this moment illustrated a broader principle. Systems built on trust function smoothly until trust is tested. The test does not arrive with noise. It arrives quietly, through actions that expose underlying dependencies. No rule was broken. No default occurred. Yet the structure was being leaned on heavily at a time when resilience mattered most. As registered inventory declined and eligible inventory remained passive, the question shifted. It was no longer about whether the system could deliver today. It became about whether it could continue delivering tomorrow if behavior did not revert to normal. That question did not yet have an answer, but the conditions surrounding it were becoming harder to ignore. And for those paying attention, it was clear that the story unfolding in silver was no longer about metal alone. By the time most analysts noticed the inventory drawdown, the most important signal had already passed unnoticed. It was not the volume of silver moved. It was not the identity of the banks involved. It was the silence that followed. Markets usually react loudly to disruption. Prices jump. Commentators speculate. Volatility expands. In this case, none of that happened. And that absence of reaction was precisely what made the situation dangerous. Large financial systems rarely fail during moments of visible panic. They fracture during periods of apparent calm, when stress accumulates quietly and decisions are made without public scrutiny. In the silver market, this calm masked a shift in institutional behavior that suggested preparation rather than response. At the center of this shift was a growing preference for physical control over contractual assurance. Futures contracts are built on the assumption that most participants will not request delivery. They rely on rollover, netting, and cash settlement. This structure works efficiently when confidence is high. But when confidence weakens, even slightly, the structure begins to behave differently. Institutions with deep market access can sense these changes early. They see delays. They notice widening spreads in physical markets. They observe subtle changes in lease rates and vault activity. None of these indicators appear dramatic in isolation. Together, they form a pattern. What that pattern suggested was simple. Some participants were no longer comfortable relying solely on promises. This shift was not confined to one region. Global supply chains for precious metals had already been strained by years of logistical disruption, regulatory changes, and rising geopolitical risk. Silver, unlike gold, is both a monetary and industrial metal. It is consumed in manufacturing. Once used, much of it is not economically recoverable. This makes above-ground supply more sensitive to disruption. At the same time, new trade restrictions from China began to limit the flow of refined material into global markets. For years, excess supply from Asia acted as a stabilizing force. When Western demand surged, metal could be redirected. When inventories fell, imports could fill the gap. That flexibility was now reduced. The result was a tighter system operating with fewer shock absorbers. In such an environment, the decision to remove metal from exchange circulation takes on strategic meaning. It signals an expectation that access may become more difficult later. It reflects a belief that timing matters more than price. And it implies that those acting early believe the cost of holding metal will be outweighed by the cost of not having it. Importantly, these decisions were made without public justification. Banks did not explain their reasoning because they did not need to. Markets reward discretion. By the time motivations are explained openly, the opportunity to act has usually passed. For entrepreneurs and business leaders, this moment offered a lesson in how risk is managed at the highest levels. Institutions do not wait for confirmation. They act on probability. They do not require certainty of disruption, only a sufficient imbalance between potential loss and potential cost. Holding physical assets carries storage costs, regulatory burdens, and opportunity costs. Choosing to do so means those costs are considered acceptable insurance. When multiple institutions reach that conclusion independently, it suggests a shared assessment of future conditions. Another important detail lay in timing. The movement of silver occurred before earnings seasons, before major policy announcements, and before any visible macroeconomic shock. This sequencing matters. It indicates anticipation rather than reaction. Those involved were not responding to an event. They were positioning ahead of one. And yet, from the outside, markets appeared stable. Equity indices remained elevated, credit markets functioned normally. Liquidity was available. This disconnect between surface stability and underlying repositioning is a hallmark of transition periods in financial history. The silver market has often served as an early indicator rather than a headline driver. Its size is small relative to global capital markets, but its role is complex. It sits at the intersection of industry, finance, and monetary history. Stress appears there early because margins for error are thin, and what was unfolding then was not a crisis. It was a signal that trust was being recalibrated, that delivery mattered more than yield, that possession mattered more than exposure. Whether this signal would escalate into something larger was not yet clear, but the behavior that produced it was unlikely to reverse quickly. Once institutions begin to prioritize control, they rarely return to complacency without reason. The silence following the transfer did not mean the danger had passed. It meant the adjustment was still underway. By the time structural stress becomes visible to the public, options are already limited. History shows that financial systems do not fail suddenly. They fail gradually, then all at once. What unfolded in the silver market was not an endpoint. It was an early warning, one that only matters to those willing to interpret it correctly. At this stage, the key issue was no longer silver itself. It was trust. Modern financial markets are built on layered confidence. Confidence that contracts will settle. Confidence that inventory classifications reflect reality. Confidence that liquidity will be available when needed. When even one layer weakens, pressure shifts to the others. The physical silver movement exposed how narrow the margin had become. Registered inventory levels were not just declining, they were approaching levels where normal delivery activity could create outsized stress. In such conditions, even routine demand can feel disruptive. The system becomes sensitive, reactive, and dependent on cooperation rather than structure. For years, markets benefited from an environment where liquidity was abundant and risk was suppressed. Central banks expanded balance sheets. Credit was cheap. Volatility was managed. Silver inventories, like many other safeguards, were allowed to thin because nothing appeared to go wrong. But efficiency has a cost. When conditions change, efficient systems struggle to adapt. The actions taken by large institutions suggested that this shift was already being priced internally. They were not reacting to headlines. They were responding to constraints. Constraints in sourcing, constraints in settlement, constraints in flexibility. These are the kinds of pressures that do not reverse quickly once they appear. For business owners and entrepreneurs, the broader lesson was not about commodities trading. It was about preparation. Large institutions survive not because they predict the future perfectly, but because they act before uncertainty becomes visible. They reduce exposure early. They secure optionality. They prioritize control over convenience. Ignoring early warnings is costly precisely because they appear insignificant at first. A few million ounces in a global market seems small. A slight inventory imbalance feels manageable. A quiet transfer between banks looks routine, yet these are the moments when strategic decisions matter most. The silver market has historically signaled broader shifts before they become obvious elsewhere. Its dual role as an industrial input and a monetary asset makes it sensitive to both economic growth and financial confidence. Stress there often precedes stress in larger systems, not because it causes disruption, but because it reveals it. What followed this episode would depend on behavior. If demand for physical delivery normalized, pressure would ease. If confidence returned, inventory would stabilize. But if behavior continued, if institutions kept choosing possession over promises, the system would be forced to adapt. Adaptation in financial systems is rarely smooth. Possible outcomes range from higher premiums for physical settlement to changes in contract terms, to incentives designed to discourage delivery. None of these are signs of collapse. They are signs of adjustment. But adjustments have consequences. They change who bears risk and who controls access. For decision makers, the warning was clear. Do not wait for confirmation from prices alone. Do not assume that stability on the surface reflects strength underneath. Pay attention to what sophisticated participants are doing quietly, not what commentators are saying loudly. The most important shifts in finance occur before consensus forms. By the time consensus arrives, positioning opportunities have already passed and risk has already been redistributed. This episode did not predict immediate crisis. It highlighted vulnerability. It showed where buffers had thinned and where assumptions were being tested. It demonstrated that in moments of transition, physical reality reasserts itself over abstraction. Those who understand this do not panic. They observe. They adjust. They recognize that resilience is built before stress becomes unavoidable. The silver moved, the inventories shifted, the system responded. For now. What matters next is whether these signals are treated as noise or as information. History suggests that those who act early rarely explain themselves. They simply move on, leaving others to ask later why the warning was missed.